Welcome to the third ApexVol companion video. As shared in video 2, today we are going to get the community started on first-order Greeks and the impact they have on trade assessment in regard to entry and exit. This will get us started with the idea of delta-neutral structuring and the idea of hedging your book. Again, this is extremely variance-specific terminology and might appear at first to be a bit much, but once we walk through them, you'll understand the specifics and you'll grasp them and how they impact structuring. The first order Greeks are delta, gamma, theta, vega, and rho. Today we will concentrate on delta. However, it's impossible to speak about delta without touching on the remaining Greeks, which will become apparent as we get further along. The textbook definition of delta is the following. Delta is the theoretical estimate of how much an option's value may change given a $1 move up or down in the underlying security. The delta's values change from -1 to +1, with 0 representing an option where the premium barely moves relative to price changes in the underlying stock. To clarify the above, we'll walk through it a bit more. If one purchased a 50 delta at the money call as the underlying assets appreciated in price by 10 cents, the call would go up 50% of that move, or 5 cents. The puts would decline in value by 5 cents, and those two moves encompass the 10-cent move in the underlying. Clearly, as the underlying moves in either direction, the delta is subject to change. For example, if we bought a 50 delta call when the underlying was 25 and the stock rose to 30, this 30 strike would now be at the money and would be 50 deltas, and our $25 call would be $5 in the money and would have picked up delta. Conversely, if the underlying moved lower from 25 to 20, the $25 strike calls would be $5 out of the money and would lose delta. This is gamma. Let us use the ApexVol dashboard and the simulation assets to get a better understanding. Through the simulation page, we will watch both the delta and the theoretical value react to price movement in the underlying asset. We are once again going to look at General Motors, GM, using the November 28th expiration as the Greeks adjust more visibly in the short duration expiry. So we are in the General Motors simulation window, and we're seeing the stock at $70.52. We are now going to simulate the stock being at $70 just to keep the stock right at strike, and we're going to hit the simulation button, and we're going to scroll down to 70, and we are going to see with the stock exactly at strike at 70, the calls are 91 cents, 99 cents, with a midpoint of about 95 cents, and they are a 51 delta. And the puts are 105, 112, with a midpoint of 108, and the delta is a 49. We're now going to move the stock up 10 cents, and we're going to watch it change a tad. So now with the stock at 70.10, we're going to hit the simulation button again. And now the delta is a 53, and the calls are 96.104 with a midpoint of $1, and the puts are a 47 delta, and they are 101, 108 with a midpoint of 104. And now we're going to walk the stock up another dime. And at 70.20, again at the 70 strike, the delta is now a 55. The calls are 102, 110 with a midpoint of 106. The put delta is now a 45, and the puts are 96, 103 with a midpoint of 99. And we're going to just do it one more time to 70.30. Okay, now the delta on the calls is a 57. The calls are 107, 115 with a midpoint of 111. The puts are a 44 delta. They are 92, 99 with a midpoint of 94. So just to give you an idea of the movement of the stock and the way the prices and the delta changes, we started out with the stock at 70, and the midpoint of the calls was 95 cents. And with the stock at 70.30, the midpoint of the calls is now 111. The difference is 16 cents. On the put side of the equation, the midpoint of the puts was 108. Now with the midpoint of the puts with the stock at 70.30 is 94, and the difference is 14 cents. So we have a 16-cent move in the calls and a 14-cent move in the puts, And together that adds up to the 30-cent move in the stock. So that's the way it works. And obviously, we have gone from a 51 delta to about a 57 delta. So we are picking up deltas as we move higher. Now we're going to move the stock significantly higher to 71 to give you an idea what happens. Again, we're going to look at the 70 strike. And now the calls are 151, 159 with a midpoint of 155, and the delta is about a 68. The puts now have about a 33 delta or 34 delta. They are 64.71 with a midpoint of 67. We're going to take the stock up another dollar to 72. We're going to simulate that. Again, the 70 strike. Now the delta is an 81. The calls are 226, 234 with a midpoint of about 230. The puts are about a 23 delta. They are 35.42 with a midpoint of 39. And just to give you an idea of the way variance works, now we're going to take the stock down to $68 to give you an idea what happens when the stock goes lower. So now with the stock at 68, the call delta, we've lost delta, it's 20. The calls are 21.29 with a midpoint of 25. And the puts are now a 75 or 76 delta in that range. They are 230, 237 with a midpoint of 233. So that'll give you an idea of the way the delta moves with the stock moving, and that is variance. And now we're going to go to a calculation window and give you an idea of how this works. Okay, so with the stock at 70 at its original point, you're seeing a calculation with the stock at 70. And if you remember, the calls were 95 cents. We are going to buy 10 calls at 95 cents. And because they are 50 deltas, we are going to sell 500 shares at 70 in order to be delta neutral, 50% of the 10 calls being 1,000 shares, representing 1,000 shares. We sell 50% of the 1,000 shares at 70. And now we're going to walk the trade up to the 72 move. And now with the stock at 72, we are going to sell our 10 calls out at $2.30. We are going to make $1.35, which is the difference between where we purchased them and where we're selling them for a positive P&L of $1,350. But we are now going to have to reverse the stock that we sold, and we're going to buy it back at 72 and lose $1,000. And the net P&L on the unwind is $350. And now to give you an idea whether it doesn't matter whether it goes up or down, it just matters that it does go up or down. Here's what the stock at 68, $2 below where we entered. Now we're going to sell out our long calls at 25 cents, and we're going to lose 70 cents on the calls we bought, and we're going to lose $700. But we're going to buy back the stock we sold at 70 at 68, and we're going to make $1,000. And we have a net profit of $300, and the stock went in the opposite direction. But we have a positive P&L because we are long the move, not the direction. And just to give you an idea, this works on the put side because puts can be calls and calls can be puts. And it doesn't matter. So here's the example on the put side of the trade. Okay, so we're going to, again, enter the trade with the stock at 70, and we're going to buy 10 NOV 70 puts at $1.08. If we recall, that's where the mean was, the midpoint. And we're going to buy 500 shares at 70 because, 50 deltas either way. Now the stock is going to go higher to 72. So the puts will go lower, but the stock is going higher. So now we are going to sell our puts back out at 39 cents, and we are going to lose 69 cents on the 10 puts, and we're going to lose $690. But we have a positive P&L on the stock of $1,000, and we make $310. And now we're going to scroll down to where the stock goes down to 68, and we're going to make money on the puts. So now the puts are $2.33. We're going to make $1.25 on the puts, $1,250, but now we lose $2 on the stock, and we lose $1,000, and we have a net P&L of $250. So that's the way the delta changes and the way that being long the variance can be a positive scenario for you going forward. So let me elaborate a little further. So I just want to make an attempt to keep this tutorial simple. We have shared a long premium positive gamma basic trade structure. As shared, the remaining Greeks would be impactful, certainly in the short duration term. However, we will address each of the Greeks in its own time. We need to further mention that it's important to view the tutorials in proper order, as viewing them out of order might lead to difficulty with assessing the information provided. We once again thank you for your time and attention and hope these videos will get you comfortable with the variance environment. I thank you again.